Specific non-deductible expenditures for UAE corporate tax purposes. In addition to the restrictions on deductions that were previously discussed, the UAE corporate tax law outlines several specific expenditures that are not eligible for deduction. These disallowed deductions are aimed at ensuring that only expenses genuinely connected with business operations and that serve legitimate purposes are recognized for tax calculations. The list of non-deductible expenditures includes a range of expenses to maintain the integrity of the tax system and to prevent abusive tax practices. The main categories of disallowed deductions are as follows. 1. Expenditures not related to the taxable person's business. Expenses that are not incurred for the purposes of the taxable person's business operations are not deductible. This ensures that only costs that are genuinely business-related, as opposed to personal or unrelated expenditures, are recognized for tax purposes. 2. Expenditures incurred in deriving exempt income. Any costs directly associated with earning exempt income, i.e., income not subject to corporate tax, are disallowed. Since the income is exempt, it would be inappropriate to allow a deduction for the related expenses. 3. Non-business related losses. Losses that are not connected with or do not arise from the taxable person's business activities are also disallowed as deductions. This restriction prevents losses from non-business sources, such as personal investments, from being used to reduce the taxable income of the business. 4. Donations, grants, or gifts to non-qualifying entities. Donations, grants, or gifts made to organizations that do not qualify as public benefit entities are not deductible. Only contributions to approved entities, which provide a genuine public benefit as recognized by the relevant authorities, are eligible for tax deductions. 5. Fines and penalties. Fines and penalties, except those awarded as compensation for damages or breaches of contract, are disallowed. This includes fines imposed by regulatory authorities, courts, or other institutions, which cannot be claimed as deductible expenses for tax purposes. However, damages awarded due to a breach of contract may still be deductible if they are directly related to business operations. 6. Bribes. Bribes are explicitly non-deductible under the corporate tax law. This prohibition is aimed at preventing corruption and ensuring that any illicit payments are not incentivized through tax deductions. 7. Dividends, profit distributions, and similar benefits. Dividends, profit distributions, or other similar benefits paid to the owner of a taxable person are not deductible for corporate tax purposes. These payments are considered a distribution of profits, rather than an expense incurred in the generation of taxable income. 8. Withdrawals by natural persons or partners. Amounts withdrawn from the business by a natural person who is a taxable person or a partner in an unincorporated partnership are not deductible. This rule applies to ensure that personal withdrawals from the business are not deducted as business expenses. 9. Corporate tax. The corporate tax itself is not deductible. Any payments made towards corporate tax liability cannot be deducted from taxable income. 10. Recoverable input VAT. Recoverable input VAT, value-added tax, is not deductible as an expense for corporate tax purposes. This ensures that businesses do not receive a double benefit claiming VAT recovery while also seeking a deduction for the same cost. 11. Tax on income imposed outside the UAE. Tax on income imposed by a foreign jurisdiction is not deductible for UAE corporate tax purposes. However, relief for such taxes may be available in the form of a foreign tax credit, depending on the applicable tax treaties and regulations. 12. Employer contributions to private pension funds. Contributions made by employers to a private pension fund in respect of their employees may be disallowed under certain conditions. Specifically, contributions that are not paid within the tax period, or in excess of 15% of the employee's total remuneration in the relevant tax period are disallowed. This limitation ensures a balance between supporting employee benefits and avoiding excessive claims. Example application. Consider the scenario where XYZ LLC, a UAE-based business, incurs various expenses during its tax period, including contributions to a private pension fund exceeding the 15% threshold of total employee remuneration, a fine for late filing of regulatory paperwork, recoverable input VAT on purchases. For corporate tax purposes, the excess pension contributions, the fine, and the recoverable VAT would all be disallowed as deductions, resulting in an adjusted taxable income.